What are stablecoins? Stablecoins are a sort of cryptocurrency that is supposed to keep a consistent price over time by being tied to the value of an underlying asset, such as the US dollar. They intend to provide all of the benefits of cryptocurrency while striving to prevent extreme volatility. Welcome to Crypto Inquiry, where we are dedicated to providing you, the investor, and the crypto curious with factual information and topics. Our goal is to keep you informed to make educated and timely decisions and remove the fog of hidden information. Nothing is meant as financial advice, and always do your own research before investing. Here we are building a community to help each other stay informed and make the most of our financial gains. The overall market capitalization of cryptocurrency can fluctuate by billions of dollars every day. Even the most valuable cryptocurrency, Bitcoin, is prone to large price volatility. Bitcoin's value has fluctuated by almost 4% every day over the last month, according to investors. Price volatility is not seen in fiat currencies such as the US dollar or the British pound. Stablecoins can also be thought of as tokenized versions of fiat cash. In principle, a stablecoin based on the US dollar is a token that will stay on a blockchain and will always trade for $1. Terra USD versus Terra and USDC. What makes them all different? Stablecoins are often linked to a currency or commodity, such as gold, and they employ various processes to keep their price fixed. The two most prevalent techniques are to keep a reserve asset pool as collateral or to apply an algorithmic formula to regulate a coin's issuance. Collateralized stablecoins. Collateralized stablecoins have a pool of collateral on hand to back up the coin's value. When a stablecoin holder tries to cash out their tokens, an equal quantity of the collateralizing assets is deducted from the reserves. A prominent example of a collateralized stablecoin is USD coin, or USDC. The reserves of the USDC are stored in secure assets that should preserve their value, such as cash and US Treasury bills. USDC is a stablecoin outlier in terms of providing exact asset and liability details. There has long been debate concerning the dependability of collateralizing reserves, in particular stablecoins, i.e., that the stablecoin's obligations exceed its reserves. Tether, USDT, is the most well-known and oldest stablecoin. With a market capitalization of $66.9 billion, USDT is now the third largest cryptocurrency after only Bitcoin and Ethereum or ETH. For years, though, it hasn't been plagued by doubts over the dependability of its reserves. Federal officials are now paying closer attention to stablecoins and cryptocurrencies. The Commodity Future Trading Commission, CFTC, issued a statement in October 2021 ordering Tether to pay a $41 million civil penalty for making untrue and misleading statements and misrepresenting to customers and the market that Tether maintains sufficient US dollar reserves to back every USDT in circulation with the equivalent amount of corresponding fiat currency. Tether continues to claim that it has enough reserves to support the $66.9 billion in Tether tokens in circulation. Furthermore, the organization has yet to fail to honor any redemption request. Other cryptocurrencies can also be used to back up stablecoins. The DAI Algorithmic stablecoin, which is tied to the US dollar but backed by Ethereum and other cryptocurrencies, is the most prominent example in this category. However, because the underlying collateral is in cryptocurrency, it is more volatile. According to experts, the DAI stablecoin is over-collateralized, which implies the value of digital assets held in reserves may exceed the amount of DAI stablecoins released. Algorithmic stablecoins. Algorithmic stablecoins keep their price stable by controlling the token supply. Terra USD, or UST, was the largest algorithmic stablecoin with a market worth of more than $18.7 billion at its peak on May 5th, before plummeting abruptly after falling below its peg. The price of Terra USD was set at $1 by the minting or creation and burning, destruction, of a sibling currency, Terra or Luna. There was no collateral, and the whole strategy was based on the automated minting and burning of Terra tokens every time a UST stablecoin was purchased or sold. This model proved to be troublesome. Terra USD experienced a death spiral in May when a wave of fear sparked the crypto equivalent of a run on the bank, with a torrent of selling depegging Terra USD from its $1 price and finally dropping the stablecoin along with its sister coin Terra close to zero. Investors were concerned about the dependability of reserves and whether Tether was adequately collateralized, but not to the same level as Terra USD. Since the Terra blockchain was formally suspended and depegged from the US dollar on May 9th, Terra USD currently trades as Terra Classic USD, or USTC. USTC is worth only 3 cents. Why do people invest in a stablecoin? Stablecoins are attractive because they are designed to survive volatility in ways that other cryptocurrencies do not, while still providing mobility and accessibility. A much more stable cryptocurrency is still decentralized, which means that it is not subject to the laws and regulations of a centralized system. This gives an entry point into the world of DeFi, with possibilities such as speedier money transfers, access to financial services without the need for applications, the protection of financial data, and the avoidance of financial service costs. Centralized stablecoins offer a digital option backed by a conventional currency. Stablecoins might not be the best investment because they are designed to maintain their values consistent rather than a surge in value. For example, the US dollar coin has never deviated from its $1 value throughout its entire life. Meanwhile, at the start of 2019, Bitcoin was trading about $4,000, but by 2021, it was occasionally trading above $60,000. Stablecoins, rather than being a speculative investment, may be best employed as a type of digital currency. Some stablecoins can also be used for crypto staking, which is a method for cryptocurrency owners to receive rewards by effectively lending out their holdings to help complete other transactions. Staking, on the other hand, includes dangers, so make sure you study the details of the currency you wish to utilize. What can cause a stablecoin to crash and pump? When Terra imploded, that promise of stability was abandoned. It was created to hold on to its $1 value. It didn't work. Tether, the world's most popular stablecoin, fell below its $1 price in May. People dismayed and astonished by their massive losses after investing largely in Terra can be found commenting on Reddit and Twitter. Such occasions are instructive. Before you invest in the stablecoin, you should ask yourself a lot of questions, since this is not a journey for the faint of heart. Here's how to assess if you're up for the wild ride that is a cryptocurrency, specifically stablecoin. You understand that stablecoin investing is just as risky as other cryptocurrencies. Stablecoins as an asset class claim to be stable. However, the term itself is misleading, according to Joe Rotunda, Director of Enforcement at the Texas State Securities Board. Rotunda also serves as the North American Securities Administrators Association Vice Chair of Enforcement. According to Madeline Hume, a senior research analyst at Morningstar, stablecoins are often backed by assets such as treasury bills or commercial paper instead of investing directly in the currency they mirror. Terra's unsuccessful algorithm concept was familiar to investors. There is no independent corroboration that assets allegedly underpinning other stablecoins are truly held in reserve in the absence of regulation and control. You understand the difference between investing and gambling. You should never invest all of your money into a single stock or asset class, especially one as risky as cryptocurrencies. You understand that greater yields imply a bigger risk. The greater the possible return, the greater the financial risk you are taking. When you notice high yields, you should instantly ask why investment has to give such a high income to attract clients. You're aware that stablecoins aren't as secure as money market funds. A money market fund is a form of mutual fund that invests in short-term, high-quality debt securities. A money market fund seeks to keep its net asset value per share at $1. Some investors may see dollar-denominated stablecoins as the cryptocurrency counterpart of a money market fund, but they aren't. Money market funds, unlike stablecoins, are heavily regulated. Your major motivation for investing is not FOMO, aka fear of missing out. Don't be afraid of losing out. And don't be fooled by cryptocurrency advertising starring Matt Damon and basketball legend LeBron James. They're already wealthy in actual money. Following the herd in an investment you don't fully comprehend might result in catastrophic losses. Don't give in to fear of missing out, Rotunda said. Don't listen to the endorsers. Matt Damon isn't a financial advisor. You shouldn't take financial advice from him. You wish to make a transaction with stablecoin. It can be beneficial to keep money in stablecoins that are getting used elsewhere in the cryptocurrency ecosystem, Hume said. Because where investors really get clipped with cryptocurrencies is when they're converting actual fiat US dollars into cryptocurrency. That's a wrap for this video. Let us know in the comments below if you think the stablecoins are a sensible investment or not. If you enjoyed this video, give this a big thumbs up. And do not forget to subscribe to our channel if you want to see more videos like these. See you next time.